Let's bring in Kevin Green, senior markets correspondent, to help set up some of the other action today. I feel like we're still, kind of digesting the latest from the Federal Reserve, and we probably will be for some time, given that they released the summary of economic projections. It seems like it was all about the dot plot in terms of how markets reacted yesterday in terms of positive momentum, but we're seeing some cooling in the pre-market. What's your take, KG?
Yeah, I mean, you're seeing a little bit of a pullback here, but I think that's more technical in nature, and we have been trying to inch our way back to the upside here. We were down about 0.6% on the E-mini S&P 500. We're down about 0.3% right now, and looks like we could hit a resistance zone at around 57.27 on the E-mini S&P 500. Look, I think yesterday was actually very interesting. When you're looking at the summary of economic projections, they were not that great. You had a re-rating to the upside when it came to PCE. You also had a situation where economic growth expectations have also been re-rated to the downside. That's kind of stagflationary if you kind of look at that print. Now, the fact that they're going to slow quantitative tightening or that balance sheet runoff might have been a bright spot for this market, but you kind of saw a little bit of a different reaction when it came to a risk on tone in the market. Equities ripped higher, but you did see a significant amount of buying when it came to treasuries, and that's also following through here today. It appears that the treasury market might be calling the Fed's bluff and saying, hey, you might actually have to cut a little bit earlier than what you expected, more than this 50 basis points by this year. And that seems like that's what the treasury market's kind of signaling, even though the equities, once again, saw some favorability there. Let's see if we actually do get a nice little rebound and a follow-through day today. But I think the sell-off that we had was a little bit more mechanical in nature, just when it comes to the overnight session, just in general.
So let's talk a little bit about a word that resurfaced. Transitory. It made a comeback. I was surprised to hear that because there was so much blowback the first time around when the first time around when there was this significant impact of that word transitory and the expectation for inflation to be transitory. It wasn't then. Now it seems like the Federal Reserve is interpreting this tariff policy as potentially transitory impact to inflation. How much weight do you give that assessment?
Yeah, I think it's as the same bad word, if you will, when it comes to market, but two different events that we're talking about. The first time that they tried to mention, or they mentioned transitory, they were talking about it in the context of supply chains normalizing, and that just took a lot longer than what the street expected, and obviously it became a little bit sticky, and then that's where we have this problem when it comes to higher inflation. The transitory nature that they're talking about right now for tariffs, you can make the case. You have a one-time adjustment to the upside when you have prices rising. We are probably seeing that right now when it comes to the sentiment data. But over time, tariffs usually are actually suppress demand. And if we see suppressed demand, that also then kind of becomes a deflationary factor on the back end side. We just don't know the timing of that. And I think that's really the context. So once again, the word transitory leaves a bad taste in a lot of people's mouths, but it's two separate situations here. I think you did see a signal from Powell around the policy saying, we want better clarity. It's really kind of, it's not that great right now to be able to try to project out what the impacts are going to be because the policy continues to change on a day-by-day or even hour-by-hour basis. But the Fed does have the ability to shift on a dime, and if they do see some weakness, it seems like they will be acting here. And that's why we kind of saw that pop to the upside yesterday. And hopefully we do see a little bit of a follow-through. But I will say, Diane, it seems like there's a massive disconnect between yield markets and equity markets, and that usually doesn't last for too long. One of them kind of self-corrects. Either yields go a little bit higher, or we see equity markets maybe seeing some challenges here after this decent bounce that we had yesterday.
Given the uptick in expectations in terms of inflation and kind of projections of deceleration of growth, what do you think about the expectations for the policy response and even still continuing to expect 2 rate cuts this year based on the dot plot?
Yeah, well, the market's so focused on the rate cut expectations, but if you kind of look at it, I mean, the average person, it really is not that impacted by fluctuating, short-term rates at the end of the day, right? We might have an impact when it comes to credit cards, maybe auto loans if you're doing a one-time purchase, but a lot of the a lot of the interest that we pay just as regular consumers is usually fixed base if you're looking at the major purchases here. I think the policy shift when it comes to quantitative tightening is probably a little bit more of a nimble policy, being able to either purchase treasuries and debt securities just in general, or the ability to run those off. That immediately impacts liquidity markets rather than maybe interest rate hikes or interest rate cuts. And I think once we get through this whole situation, you'll probably see a little bit of an after action type of report, and they'll probably recognize, like the market recognizes, QE is probably more of effective policy to impact inflation and impact markets rather than waiting on interest rate adjustments that have just taken way too long for them to see the impacts here in the general economy.
And then I want to get your thoughts on some of your takeaways from Darden earnings. Seems like a very different picture from their last quarter, where for them the consumer was showing up and they were feeling better about the consumer. Yeah,
so Darden, it was actually a very interesting report, kind of a mixed report here. They did miss on the top line when it came to revenue. That came in at $3.16 billion. Street was looking for $3.21 billion. And the adjusted earnings per share, excluding the Chewy acquisition, came in at $2.80. Street was looking for $2.79. But the problem that you actually have is sales growth increased by 6.2%, but that was all due to the Chewy acquisition. So organic growth actually kind of stalled out. And you did see a miss when it came to sales, same-store sales for Olive Garden as well as Longhorn, Steakhouse. And so they are seeing a little bit of pressure right now. And their guidance is also forecasting that. Not so much when you're looking at the fiscal year 2025 adjusted earnings per share, which did beat the Street's expectations. But when you're kind of looking at the total sales forecast, depending on the estimates that you're kind of looking at, came in a little bit light. So there might be a concern around inflation just in general, maybe a slowing when it comes to the consumer here. And when you have same-store sales slowing down or decelerating for two of your major franchises within your portfolio, that's always going to be a concern. So we did see a little bit of a move to the downside. Last time that I checked, though, it was down only about 0.6%. So it looks like the market's still trying to digest these numbers.
It does appear that, especially, when you see the results from Olive Garden, which was a standout, but Longhorn was really their standout in the prior quarter. Right now, shares of Darden restaurants down about 1.25%. Thanks a ton, KG, for what to watch today, the reaction to Fed.